Good morning, everybody. If things are working out the way that they were planned to, it should be Tuesday morning, March 31st, and you should be looking at a slide of Friedrich Augustus Hayek, our current influential economist of the day. I will start out by saying that while you cannot make use of the active links on this particular video, that this slideshow is uploaded to your class materials in Google Classroom, and you can pop open the PDF file that has the slides in it, and you can click through the links that I've identified with the word play in order to see the videos. And I will also say that the first video under Friedrich Hayek is actually one that we did see the Thursday before the long weekend if you were in class. So if you were present our last day in the actual classroom, you've already seen the original video, which talks about the life and times of Friedrich Hayek and some of his ideas. So there would be no need for you to review that video again unless you actually just wanted to refresh your memory. But for the purpose of today's video, I am going to treat this as if we had not started on Friedrich Hayek before taking our break. So some of the information that you get in the video today may be redundant. I assure you that by the time we get to the end of the block on Hayek, we will be entirely into new material. So first of all, Friedrich Augustus Hayek, he's a member of the Austrian School of Economic Thought. He was, in fact, a protege and student of Ludwig von Mises, and was a contemporary of John Maynard Keynes, the two economists that we've looked at up to this point. John Maynard Keynes and Friedrich Hayek were both publishing during the periods between 1920 and 1946. John Keynes passed away in 1946, and they have economic ideals that are very different from each other. And as such, they often came head to head in arguments on public forums and such. If you remember from the video that we saw on Friedrich Hayek, there was one time during World War II when they were actually sharing a post on nighttime bomber watch on the top of a chapel. And nobody really knows what they talked about, but being as how they were constantly at odds with each other in their correspondence and in their publications, one can only imagine that it was an interesting conversation. So we're going to look at 3 points that Friedrich Hayek is responsible for. The first two there, we're going to go into some great detail, the Austrian theory of the business cycle and the pure theory of capital. So I won't touch on those right now since we'll be looking at those in the next 2 slides. But I do want to touch on that third point. If you remember back when we first started talking about economics, we talked about basic terminology, and we discussed the difference between the words equity and equality, and how on the political spectrum, the two sides of the economic equation, the point on how involved government should actually be in the private economy, the two ends of that argument were based on the concept of equity versus the concept of equality. So when we talk about equity, we talk about everybody in society having an equal starting point and being able to progress through life at whatever speed is dictated by their natural skills and abilities, their education, the amount of effort that they put in, etc. And how in an equitable environment, people do not necessarily end up at the same point as each other. Everybody starts at the same point, and where they end up is based on a number of different factors, many of which they personally control. The definition of the word equality, on the other hand, is based on the theory or the idea that regardless of where you start, regardless of your natural skills and abilities, regardless of your education, your profession, your income, your genetics, regardless of any other factor, no matter where you start on the economic spectrum, you all wind up at the same point at the end of the day. And this is sometimes called the equality of material position. And in the equality of material position, it is essentially, according to the Austrian school, up to the government to establish the parameters by which this equality of material position can be achieved and maintained. Friedrich Hayek goes on to say in greater accusation, um, if uh, in a matter of fact, that any claim for equality of material position, which means basically anybody saying that this equality can be achieved, has to accept that the only way to do so is for the government to have absolute power over the personal lives of the people in that economy. So in order to ensure that everybody winds up at the same finish line at the same time, the government has to be able to control what you buy, what you sell, what you make, how much of it you make, what the prices are going to be. Price ceilings and price floors have to be established. And in many cases, the government is going to be supplying you with the means to purchase what they have dictated that you must purchase, or the means to produce what they have dictated you must produce. Without these totalitarian powers, without this complete and total lack of personal liberty, there is no way that the government can guarantee that everybody winds up at the same point when all is said and done. So keep that in mind as you're going forward. If you remember from your vocabulary sheets, two of the terms that were on there were libertarianism and classic liberal thought. And both of those are based in the theory that personal liberty is an essential component of a healthy economy. Um, they're both rooted in the Austrian school or the Chicago school thought that the less government intervention made into the economy, the healthier the economy will be, because people are allowed to make their own choices both in production and consumption. Now, moving on, we talked a little bit about the Austrian theory of the business cycle. We didn't talk about the theory as much as we talked about business cycles in general. And if you remember correctly, when we talked about it, we talked about a business cycle having its booms and its busts, and how, in general, business plans try to flatten out those ups and downs. The well, to actually start over a little bit, we talked about businesses that start up. They have in the modern idea of what a business cycle is, they have what's called a startup phase, and usually this lasts anywhere from about 6 months to about 2 years. And this is the time when the business is it's getting started, it's having initial purchases of capital assets, the establishment of marketing plans, production plans, sales plans, transportation plans. There's a lot of planning that goes into that startup phase. And the rollout of the business where its products and services are presented to the public is not the end of the startup phase. The rollout is actually fairly close to the beginning of the startup phase, but a lot of that startup phase is pre-rollout, planning, securing of financial assets and things like that, and then putting it all together, getting the parts, the moving parts put together into a cohesive business, rolling it out to the public, and then establishing your niche in your chosen market. And then after the startup phase comes a phase of very rapid growth. It's called the growth phase. And this growth phase lasts pretty much from the end of the startup phase out 2 to 5 years. And when we were talking about this, one of the things that I mentioned in class is that in the United States today, approximately 95% of all businesses started in the United States will fail in that first 5 years. Bankruptcy, out of business, gone. And that of the 5% remaining that actually succeed, about 9 out of 10 of those are actually not private businesses. They're franchise businesses where there is a servicing corporation like a McDonald's or a Best Western or some other major corporation that does all of that startup and growth work for you, and you purchase what's called a turnkey business, and that you are banking on the franchise name to bring in your customers. Well, the Austrian theory of the business cycle is what comes beyond that initial growth phase when we get into what's called the sustainment phase. And in the sustainment phase of government, again, you've got these ups and downs that the business owner is going to try to keep as flat as possible in order to have a stable business. When businesses are looking for growth beyond that first 2 to 5 years, what they're looking for is a slow, steady growth that's going to allow them to sustain profitability over the long period of time. Under the Austrian theory of the business cycle, if those relatively shallow booms and busts start to become too steep, on the upturn, the business has a risk of becoming overcapitalized. We'll talk about that in more detail in just a few minutes, where the business starts to exceed its actual value. If you remember from the stock market game, some of the research that you hopefully did on particular stocks would talk about a stock being overvalued or undervalued. If a stock is overvalued, it means the price of the stock is higher than what the company is actually worth. And on these excessive booms, if a company like that becomes overvalued, when they start to build debt, it can become a bad thing if that debt is secured by the value of the company. Again, we'll talk about that in great detail in a minute. The bust cycles then become much deeper. Shallow busts are very easy to get through. If you're banking some profit, when there's a small business turndown, you can ride out that turndown until you come back up to profitability. But if you get a really steep bust going, what ends up happening is you can get yourself into such a hole that you are barely making ends meet, if at all. Debt may be piling up faster than you can pay it down. You may actually have loans that reach the end of their term and the bank calls those loans in. You can't cover the payback on the loans and that sort of thing. And that bust just takes you right down to the bottom, where you essentially have to do one of two things. You either beg the government for a bailout or you go out of business. And the Austrian theory of what turns these nice shallow ups and downs into these steep booms and busts is the central bank's expansion of credit. So if you remember, we talked about the central bank, in this case, the Federal Reserve, controlling both interest rates and the money supply in the US economy. And when interest rates are brought down, this makes it easier to borrow money. It gets more money available to inject into the economy, and can stimulate an economy that's otherwise a little bit sluggish. When the interest rates go up, money becomes harder to borrow. Money is actually removed from the economic system, and the economy will slow down. But at the same time, because of the uh, limit on the amount of money in the economy, the Federal Reserve may want to slow growth in order to avoid inflation. So what the Austrian theory says is that when the central banks adjust their interest rates too far in either direction or too fast in either direction, what ends up happening is they end up creating these huge, steep cycles, and that it's actually the Federal Reserve's misallocation of um, monetary policy that leads to that 95% of businesses failing, that leads to that 1 out of 10 successful businesses, only 1 out of 10 successful businesses being small businesses able to compete against the corporate giants, the franchises. So when interest rates come down too fast or come down too far, generally speaking, banks are more willing to loan money. Companies and individuals are more willing to borrow money and spend that money. And the first negative thing that happens is what's called overcapitalization. And capitalization is loosely defined as a business taking on a debt load higher than the net asset value of the company. So to put that in terms of an example, as a company, your net asset value is the value of all of the assets that you own outright. So any assets that are partially owned, you only get to count the part that you own. Any assets that are mortgaged, you don't get to count the full value of the asset, only the amount of principal that you've actually paid off on the mortgage. But you total up the value of the equipment that you own, the value of the inventory that you own. You don't get to count the value of people that you employ. You don't get to count the value of anything nebulous or fluid like that, only dealing with the hard assets. And you also get to count the amount of cash that you actually have on hand. And let's say you own a small business and your net asset value, the value of all your equipment, all of your inventory, all of your office supplies, all of, everything, literally the telephones, the printers, uh, the computers, everything that you own comes to $1 million. And let's say that the interest rates have come down. The prime lending rate is at 0.5%. Business loans are being made through the Small Business Association at rates as low as 2% interest. And you decide that if you could just get your hands on some of that cheap cash, that you could get into a growth surge. You could grow your business and increase your net asset value. So you go borrow $500,000. You have now borrowed 50% of your net asset value. No big deal. If the loan gets called in, you have the assets available to liquidate and be able to pay off that loan. But let's say you borrowed $1.5 million on the understanding that you're going to be worth more at the end of that growth phase. If the growth phase doesn't go your way, say the overall economy takes a downturn, and you are unable to secure new customers or unable to research and develop new lines, you don't increase the value of your company enough to be at least equal to the amount that you borrowed, and the loan comes due. You all of a sudden don't have $1.5 million to pay back the loan. Even if you sold everything you had in the business, you would still come up $500,000 short. This is overcapitalization. If it gets really bad, it goes into what's called hypercapitalization. I've actually posted an article in the Google Classroom class materials that you can check out that talks about the concept of hypercapitalization. And hypercapitalization is where a company wants to overcapitalize, but they don't want to look like they're overcapitalizing. So what they do is they start assigning subjective value to things that ordinarily would not be considered valuable. They might, well, for instance, one of the examples in the article, they talk about universities that encourage investors to buy into the university, actually buy stock in a private college, by publishing their net asset values in their board of directors reports. And they will show the value of all the capital assets, the value of any buildings, the value of any equipment, laboratory equipment, groundskeeping equipment, anything that that can be physically sold and turned into liquid cash. They talk about all of the things that any normal business would talk about. But then they will start to assign value to things that are either very high risk or subjectively only valuable for certain things. For example, they might assign a value to a dormitory room. And when they do that, they will not assign a value based on what the student is actually paying to live in that dormitory room. What they will do is they will go out into the community and they will find what the value is of a one-bedroom apartment. And they will assign that value to the dormitory room, multiply it by the 2,000 dormitory rooms they have, and show that as part of their net asset value. So by creating value out of nothing, they not only become overcapitalized, they become so overcapitalized that when those loans are called in and the bank is expecting you to be able to convert your assets to cash, well, nobody's going to buy a dormitory room. So the value is essentially either zero or limited to the cash that the student is actually paying to live there. And then it's only valuable if you actually can get that cash from that student. So overcapitalization, if it continues, it goes to hypercapitalization. And then the third and the worst one is where you get into inflation or hyperinflation. And when we talk about hyperinflation, what we talk about is as loans start to fail, people have overcapitalized and they can't pay back that money. The banks, in order to cover their losses, will start jacking those interest rates up as quickly as possible. And when they do, that's going to affect the availability of production revenue for these companies. But also, and more importantly, what's going to happen is companies that have overcapitalized or hypercapitalized are going to start to fail, and they will start to be removed from the production side of the market. And as they are removed from the production side of the market, the availability of goods decreases rapidly, but demand for those goods either hasn't changed or has actually increased because the consumers were also getting easy money and have more money to spend. So as that demand continues to skyrocket and that supply starts to drop off, prices will go up because people who want something more will offer higher prices in order to lock somebody else out of buying it. So hyperinflation then becomes the third and final critical mark of that central bank's inflationary credit expansion. Now, conversely, if an economy is growing too quickly, by the way, the last time we saw an economy grow or go into that hyperinflationary um, mode was during the Jimmy Carter administration. If you looked at about the midpoint, late 70s of the Jimmy Carter administration, at one point we had inflation running in excess of 12% per year. We had interest rates as high as 17, 18%, mortgage rates as high as 15%, credit cards going as high as 30 or 40% interest as the banks were rapidly trying to cover their losses um, after seeing a crash following a period of easy money. Um, we haven't hit that point since then, but of course the risk is always there. Now, when we look at those interest rates skyrocketing, when the central bank, in this case the Federal Reserve, sees an economy that's moving towards hypercapitalization or inflation, they may start to raise that prime lending rate up very, very slowly, hopefully, in small increments, and wait to see what impact it has on the economy. And they're looking for an equilibrium point. They're looking for the point where the money supply, the inflation rate, and interest rates are all starting to come together at that nexus, that crossing point. But if they raise those rates too high or they raise them too quickly, now what you have is almost immediately the money supply in the economy will drop off. People can no longer borrow money easily or cheaply. Credit card rates will go up. Mortgage rates will go up. So people stop buying things. They can't borrow the money, so they stop purchasing. And we get into what's called a stagnant economy. A stagnant economy is one where growth is effectively less than 1% growth per year. And when we see slowdowns like that in the economy, people always start talking about the worry of a recession, because if the stagnation continues, the next step is, in fact, a recession. Now, we've seen multiple recessions in my lifetime. We've had at least two that have occurred in your lifetime. And right now, because of the quarantine, we're in a period of stagnation, which very quickly could become an actual recession if the um, social distancing laws continue for much beyond the middle of April. But even a recession is not a terrible thing. You will see in recessions where certain niche businesses, businesses that cater to a very small group of clients, um, peculiar product or an unusual service that doesn't draw very many people from the start, if they lose even a few of their customers because of lack of disposable income, it puts them in financial trouble. And in a recession, you will see businesses that in a boom economy might be able to continue that will start to go out of business. And you will see unemployment increase. You will see underemployment, which is people who would prefer a full-time job but can only find part-time work, or people who have a degree in electrical engineering that can only get work as a cashier at Walmart. Whatever it is, you will start to see some of these things that are the result of an economy that is slowing down to a crawl. And in a recession, you are literally at a near zero annual growth in the economy. If that continues, then we go into what's called an actual depression. Now, despite what you might read in op-ed pieces, despite what you read in um, social media, we have not had an actual depression in this country since World War II. The Great Depression in 1929 to about 1943 was the last actual depression. We have had some recessions that have been on the bad side, but in an actual depression, you see the entire economy collapse. You will see the governments start to run into problems because in an actual depression, the government has probably already blown through any surplus that they might have had, trying to prevent the recession from getting any worse. And the government will start to pile on more and more debt. Well, as that happens, banks will become less and less willing to lend the government money because the higher the debt goes, um, at the same time, tax revenue will be falling because businesses are going bankrupt, people are losing their jobs, investments are not producing profits that can be taxed. So the tax revenues start to drop off. The government has less principal available. Banks will start to get worried that the government won't be able to even pay back the interest only on any borrowed money. And so the government will effectively start to run out of money as well. And when you see businesses that start failing in like entire industries, um, where technology sectors or iron steel manufacturing sectors, where nobody's buying steel, so the entire steel market collapses. This is when you start to see the actual effects of depressions. On the upside, depressions are an excellent opportunity for small business people to actually start a new business. As a matter of fact, many of the mega corporations around these days started in a barn in the 1930s as the result of some guy just trying to make enough money to feed his family. The one that I like to point out is NCR, which is the manufacturer of business equipment. Um, NCR stands for National Cash Register Company, and it started as a guy in his garage who was taking broken adding machines, taking them apart and rebuilding working cash registers out of the parts of broken adding machines. And um, up until just a few years ago, it was actually a multi-million-dollar company. I believe they're still around, but in any case, so if interest rates drop too far too fast, overcapitalization, hypercapitalization, inflation. If interest rates rise too far too fast, stagnation, recession, depression. All right, so let's talk for a minute about the pure theory of capital. If you remember when we were talking about Ludwig von Mises, we talked about the general Austrian school of thought, which is that government is never in a position to plan an economy because government does not have the ability to forecast accurately ahead as to what products and services people are going to want to pay for 2 to 5 years down the line. And that one of the problems with a planned economy, in von Mises' words, a socialist economy, is that not only will the government likely be wrong in their predictions, But in a managed economy, once the government makes their decision, they're going to turn assets to the production and marketing of whatever product or service it is they've determined we need. Once that happens, those assets are no longer available for other products and services. And once the government figures out that they've made a mistake, it takes a very long time to turn an entire industry from the manufacture of one set of products to another. The pure theory of capital takes that same collection of theories and makes it relevant to the central bank. Thomas Jefferson actually said that in his mind, a central bank issuing a common currency was a greater threat to personal liberty than a standing army. And Thomas Jefferson was very much against the creation of a central bank. In fact, many of the founding fathers were very much against it because they all saw the negative effects of central management in the free market economy. The pure theory of capital explains what happens when you take a monopoly, and the Federal Reserve is a monopoly. It's a private bank contracted by the government to control the money supply in the United States. The Federal Reserve, no matter how brilliant the Federal Reserve chairman is, no matter how many smart people they have on their board of directors, there is no possible way that that central bank can acquire sufficient data, sufficient information to plan for everybody in the United States what they're going to want 2 to 5 years down the line. The beauty of individual businesses and individual people doing their own planning is they can plan for a very narrow area that is relevant to their business or to, in the case of consumers, to their needs. So they plan in a very narrow scope. The Federal Reserve is trying to plan for 330 million people in 50 different states and 8 or 9 different territories across a huge socioeconomic spectrum. They can never possess, according to the pure theory of capital, enough relevant information to figure out how to govern the supply of money, nor how to use that authority effectively and efficiently. So the control of the interest rates, the control of the currency actually entering the economy is based on the Fed's best guess, and the pure theory of capital says that the Fed's best guess is still crap. Now, I tried playing this video and having it the sound cycle through my microphone. It did not have much success, which is why I'm retaping this entire block of instruction. But I highly encourage you to pull up this slideshow in Google Classroom and click through to the video. It's a rather entertaining video which goes into great detail about the fundamental disagreement with Friedrich Hayek and John Keynes on what role, if any, the central bank should play in the U.S. economy. And I can guarantee you that there are questions on the exam for which the answer can only be gotten by watching this video. But I can also guarantee you that it is rather entertaining. So please, when you're done listening to the slideshow here, go back and click through that video to listen to Keynes and Hayek battle it out on the role of the central bank. Now, the last thing that I'm going to talk about is, and don't worry, this is a rhetorical question. I don't expect you guys to answer it for credit. But the question for consideration is when we look at the role government plays in the American economy, the government only has one source of income, and that is taxation of some kind. It might be duties and excise taxes. It might be income tax. It might be a national sales tax or a value added tax. It might be consumer taxes, federal taxes on cigarettes, federal taxes on gasoline, federal taxes on luxury sales, purchases of airplanes or yachts. Might have to pay a luxury tax there. Whatever source of income it is, it's the only source that the government has. So the only way the government gets money is by taking it away from somebody else. Now, John Keynes says the government needs to have that money so that they can build up the slush fund. So if the economy starts to falter, the government can then push that money back into the economy in the form of stimulus. And therefore, it's a good thing for the government to take money away from people and in order to increase overall spending throughout the economy. Friedrich Hayek asked the fundamental question, what's the difference between the government taking money out of the hands of consumers and then pushing it back into the economy, or consumers keeping that money and pushing it back into the economy themselves? And Hayek tries to make the point that when the government does it, the government, again, is trying to do it on that macro scale across that population of diverse needs and wants. Whereas individuals doing it across a much smaller scale are much better equipped to make the decision on when, how, and where they spend their money. So the fundamental question for consideration is, what's the difference, if any? And if there is a difference, is it more beneficial or less beneficial to let people make their own financial decisions, or to let the government make certain financial decisions for them? Again, I tried this video without having much luck with the sound. So again, I highly encourage you, go back to the slideshow in Google Classroom, scroll down to this slide, hit play, and what you will see is, again, a very entertaining video. Actually, I think much more entertaining than the last one, which is an actual debate between Keynes and Hayek on many of the principles that are inherent in this question. And both of them give examples in the actual economy of the United States since World War II up to just a couple of years ago to justify their respective arguments. So all of that being said, when we come in tomorrow, we are going to talk about Milton Friedman, the only economist on our list that I have actually had the privilege of meeting, founder of the Chicago School. Until then, please go back through the slides, read through them again, compare them to your notes, but also make sure that you click through and watch those videos, because information from those videos will appear in the exam. Also, a reminder, if you have any questions or comments, there is a place in the Google Classroom feed where you can ask specific questions. Those questions will be visible to the entire class, but please ask them anyway, because you might be just one of several students who have the same question. And I will respond to any questions as quickly as I possibly can. So until tomorrow, you guys have a great night, and